good afternoon. You're watching Closing Trades on ET now. I'm Anisha Jain, with me is Aisha Faridi, and the overall cheer for the festive season seems to be missing a bit in the market because on every rise there is a sell on rally that is happening, and today exactly what followed suit. There was that rally that happened on an intraday basis and we thought we are out of the woods, we are in the green. But no, the profit booking really set in and we are now at the lowest point of the trading session. So definite weakness really continues for the market. 24,350 at the index level. It's a deeper gash when you are looking at the bank Nifty, and not very surprising given the fact that that index was outperforming on the upside as well. So maybe it has more to give. As of today's concern, ICICI Bank is down 1.5%, HDFC is down 1.25%, Axis Bank, Kotak Mahindra Bank. So some of these private banks are letting go at the moment. Cipla, of course, with no guidance uptick coming in, the street is a bit, a bit unenthused, and ditto can be said for Dr. Reddy's as well. Having said that, Adani Enterprises and ports are doing well in the trading session, and a couple of these auto companies like Maruti, Hero MotoCorp, ahead of that, data for the entire month are fairly active. Broader market, Capri deserves a mention, and so does Poonawalla FinCorp. Readington, wherein we just spoke with the management earlier in the day. On the losing side, 5-star, the guidance cut. Honeywell down 8% and MCX Aisha. These are the stocks which are on the back foot. But it's clearly about our own markets and the way the volumes are on the lower side because globally there's not much action.
Yeah, there's not much action, though the bias today globally as well is a little bit weaker, especially the European markets. You're staring at a downtick of about 75 points on the DAX alone. FTSE is down near about 0.5%, a 1% cut coming in for the CAC as well. And even the broader FTSE MIB is now knocking down by about almost 300 points. It's, of course, the growth data as well as the UK budget, which is awaited, and that's getting the market a little bit nervous. Let's check in on what the US futures are up to, because that's also not something a whole lot to take on from. Relatively quiet all across. A 1% uptick is what you've seen now on the oil prices, though. What about gold? That gold rush really continues. A little bit softness coming in for silver, but gold runs up unabated. It's marching to a record high once again, or I should say fresh record high. But that said, let's welcome on board our chartist and try and dissect what's really happening with the market right now, because yes, the volatility is creeping in. Although it is, much narrower a participation, like Anisha said, volumes clearly drying up ahead of the festive break. But Kunal, what is it that you're making of the texture of the market today? Because every uptick is getting sold into and dips getting bought.
Yeah, and the concern for the markets today is the lack of participation coming out from large cap names, and especially the ones which had done exceptionally well. So what's actually been happening as a pattern over the last few days is that stocks which run up 4-5% or 3-4% and become sector leaders, apparently the next 1 or 2 days these stocks they tend to underperform, and that's one of the major reasons why the indices are also not getting into a follow through breakout. So for example, we were discussing the morning that Bank Nifty is on the verge of a breakout, which could be around the 52,500 mark for the index on the spot spot charts. But then I think today we've managed to correct by 400-500 points, taking resistance at that point of 50 to 500 for the Bank Nifty. And same is the case with the Nifty. We're stuck into this 400-500 point band, 24,000 as a support, 24,500 as a resistance. So I think this is the time where we may not expect the index to get into a trend, but the action could be a lot more stock specific. I think expiry could be the other reason why the markets are behaving the way it is. Because in the last few days we've seen juggling of positions and sudden change of stance from traders from being put writers to call writers. So I think when you see that kind of a scenario, you're expecting the markets to be a lot more volatile, but probably confined to just about a trading range.
Yeah, and volatile they have been. Pull up the India VIX and you will see intraday there has been a bit of a spike. We're above the mark of 15 on India VIX. So despite lower volumes, the volatility continues to be on the rise. Let's pull up the advanced decline ratio as well and take a look as to how the overall momentum is in the broader markets, because at the start of the trading session they were outperforming. That texture is maintained for now, at least for what it's worth. There are more advances than declines at this point of time in the trading session. Quickly, let's take stock of some of the buzzers then. Voltas, for instance, is in focus. It's materially off the lowest point of the trading session because over the con call, the management talked about how the gross margins are expected to get better. They are expecting good growth going forward as well. Naresh, a view on Voltas?
So the stock has corrected a bit, but overall, if you look at the rally which it has seen over the last 3 to 6 months, it's been very strong. So at current levels, I would expect it to consolidate unless it goes to 1600 odd levels where it becomes a buy. Otherwise, it remains in a range of say 1600, 1650 on the downside, and 1900 would be tough to cross.
Right. Okay. Let's just address some of the stocks as well in focus. And Voltas, of course, has been reacting to its numbers. The margins have seen an expansion of 277 basis points. There's Q2 profit, which has also been up quite staggering. If we were to just bring up the intraday graph of Voltas, perhaps that's going to give you the true picture of how the stock reacted to its earnings. And from there, the kind of fall that it had, a little bit of a gap up, and then from there it's just eased off, 3.5% lower right now for Voltas. Capri Global, that's seen an NI uptick of about 24%. The PAT has seen an uptick of 81%. That's the other one in focus. And Marico, wherein the margins have seen a downtick of about 50 basis points, a revenue uptick of about 8%, but that's a tad bit better than what the street was anticipating. So Marico, of course, has managed to hold out through the day today. But Sunil Subramaniam as well joins in on the show right now to talk about where he's seeing value in the market. Sunil, hi, good afternoon, and wish you and your team a very happy Diwali from all of us. Just wanted to understand, how is it that you're maneuvering the market right now? Anything that you've bought in the current decline?
First of all, happy Diwali to all of you and the viewers. Well, in the recent decline, I have been in the positive and bullish on the banking space. I think that the recent corrections are all not justifying of the future. And I think that it's because FIs are selling and they form a large part of the large cap index, and naturally profit booking represents an opportunity there. But that's where, because the FIs are doing it that way, I think that's where I think I'd be bullish. So to me, banking and financial services is a key segment for the next year.
For some of these key segments for the coming year as well, but overall there are these individual movers which are moving on decent amount of volumes. Kunal, for instance, MCX, that one is trending lower. No specific news flow that I can track on that one. Of course, a lot of chatter around it. And on the upside, you do have a name like Capri Global, which continues to gain ground.
So MCX is something which I believe on the short-term charts is still looking attractive. The stock is trading much above its longer-term averages, 50 DMA. The stock is making a pattern of higher highs and higher lows. So there's nothing major in terms of the chart patterns which could probably indicate that maybe the trend has reversed for the stock. So we'll look out for supports in the range of 6,000 to 6,150 for MCX over the near term. Until the time the stock closes above those levels, we can expect that this trend may continue. Capri Global is something which I don't track, so I'll skip that.
Okay, skip and Capri Global. Kunal doesn't track it. But L&T, let's just mark that stock as well for you. Holding higher by about 1% as we speak right now. BEL has seen quite a fair bit of momentum. I think a good 4% of an uptick is what it closed the day with yesterday. Right now also holding up about a good 2% as we speak right now. Sunil, has the time come to now selectively looking back at PSUs? And I'm going to keep the banks outside of this list.
Okay, you keep the banks because PSU banks are among my top picks right now in the PSU space. But if you want to take out the banks, I think, see, one thing to remember about the PSUs is a lot of them are linked to global sectors. Like the energy is linked to global cyclical, metals are linked to global. So I think what happens with the election, Trump, and with China, and what leads to the metals pack would reflect on the PSUs. So I would say that to expect a revival in the PSU segment, I would look at metals and energy. They are the big part of the PSU index, and what happens outside India rather than what's happening inside India. Inside India, within the PSU space, is the power sector I remain bullish on.
That you're still bullish on, but we have been speaking with a lot of managements today. So let's try and run you through the sound bites of some of them. Readington, for instance, is doing well in the trading session, and there are a couple more which are in focus. Let me toss it across and hear out what the management had to tell us earlier.
I consider Q3 and Q4 will also have its growth momentum, while the seasonalities will move from the consumer-oriented, mobility-oriented to large deals and technology solutions, and we expect the growth rates to largely continue in the remaining H2. The gross margin will tend to sustain and grow and will not be always as we probably see it this quarter. And a lot of these margins that are now on provisions will obviously come back as we sell these stocks moving into Q3. That should probably set the gross margins up and proper. If you would look at our last many quarters, our CAGR growth, either on revenue or on EBIT or on PAT, has always been between 14, 15, and 16%. So we would obviously continue to sustain our gross margins at the levels that we have been seeing at an average in the last about 6, 7, 8 quarters. Now, COVID and pre-COVID had a certain advantage, but now that the markets have come back to normalization, we expect that to definitely be around the 4% plus, 4 and 4% plus.
More price corrections will be required, and that is something that we've already started, beyond what we had earlier planned. The overall investment in wellness and telemedicine and home care services, all of these we believe will start paying us some amount of returns over an extended period. Finally, we have to, as an industry, work towards profitability. So,
looking at an overall growth of 18% this year to achieve our target of 18,000 crores, which we are very much on track on. On the OPEX side, the company continues to be the best in the industry as far as our expense of management rates are concerned. And I think it will only improve going forward with our investments that we are making in tech and other areas.
Back with closing trades right here on ET now. Choppy as it may be, we're down about 0.5% right now, around the 24,350 odd market trade. Trent lower by about 2%. ICICI Bank is down about 1.6%. There's where's SBI? That also is a little bit soft after 2 days of a heady run. 1% lower thereabouts is where SBI as well is in trade right now. Axis 2 lower by about 1.5% as we speak right now. You could add Kotak and HDFC Bank also to that list. Kunal, how soon do we see a comeback by the banking pack, and would it once again be led by an SBI, HDFC and ICICI Bank, or would you think it will be more broader if the banks were to rebound again?
So I think the leadership will still maintain with ICICI Bank, SBI as well as Bank of Baroda. There could be possibility that many of these mid-cap end of the private sector banking names in the the PSU banking lot, for example, the likes of City Union Bank gave a breakout yesterday or day before when it crossed about the 177 plus mark. Today, even though the stock has gone through a correction, but it seems like that many of the stocks are trying to make a comeback. So when you see few leader stocks or few stocks which act as leaders in terms of price performance, it gives room for the other underperforming names to try and make a comeback, provide their short-term breakouts, or come back about their longer-term moving averages, as the case may be. So I believe that there could be a two-pronged move for many of these banking names. The first initial part of the move, which we've seen in the last 3-4 days, was that the private sector banking names, ICICI Bank, HDFC Bank, etc., they managed to lead the charge from the front, followed by strong moves or supporting moves coming out from SBI, Bank of Baroda, etc. And then once these stocks get back into a zone where they trade from at least 5 to 7% buffer from the previous swing lows, that's where I would believe that the mid-cap end of the private as well as the PSU banking stocks should start to outperform.
Okay. Right. In the meantime, we've been getting mixed views from the likes of Neelkant Mishra, Hiren Vaid, Prashant Jain and Ravi Dharamshi when it comes to banks in particular on whether or not you should be looking at buying into them right now. Let's hear out a slice of their opinion.
Financials, frankly, are the cheapest sector. The raw material that they work with, which is the quantity of money, had been in short supply. And for what it's worth, the RBI is signaling that it is willing to provide the liquidity that is needed to sustain growth. And that at the margin, that means that banks that have the scale and the skill and the capacity to lend will be beneficiaries.
On the liability side, it's becoming difficult to raise deposits. And on the asset side, your most profitable segment is credit cards and unsecured lending. That's where the RBI is very uncomfortable if there is significant growth. So your most profitable segment, the RBI is putting the brakes. And on the liability side, you're finding it difficult to raise deposits unless you substantially raise deposit rates, in which case your NIMs will get impacted. When you are playing the big private banks, what growth are we playing? Essentially mid-teens growth, right? And that also not everybody is able to get that kind of growth. ICICI probably is an exception. Maybe Axis did well. But neither Kotak nor HDFC has been able to deliver that kind of growth. I think that you can get the same kind of growth in capital marketplace, though they may be more volatile.
The banks are offering relatively better value, and that is what has been the case for some time. I think there, the while earnings growth will be in low to mid teens, I think there is some scope, a limited small scope for multiples to re-rate as well. At least the multiples don't appear to be excessive. Chances or room for a de-rating in multiples is probably not there.
These central government driven capex cycle will pass on the baton to private sector driven capex cycle, because finally government has left the elbow space for the rates to come down. Government is trying to stick to the fiscal discipline, and their ability to push the envelope has kind of reached a limit. So private sector needs to pick up the baton over there. But what is happening is a lot of this capex is actually getting funded through equity rather than through debt. So we need to see that confidence coming back for the corporates to start taking leverage for the future projects. That re-leveraging of the cycle should begin from this year onwards is our bet. So from that perspective, the large corporate lenders should do well.
Okay, some of these corporate lenders should be doing well in the trading session, but yes, just getting set for the festive season, though the market continues to be a bit subdued. Maybe the market participants have already gone home, but apart from of course that Coldplay frenzy that we saw, Aisha, now it's expected to be a Maroon 5 frenzy because they are coming to India.
But the thing is, will we get tickets for any?
That's the big question, and perhaps the pre-sales and the ticket sales start on November 6th. The event is in December sometime. So now people are watching out for that one. So let's see whether that consumption boost really does play out or not. Sunil, what's your take on this consumption overdrive that we are seeing? Of course, the upper end doing quite well, but rural, mid, mass segment still a bit weak.
Yeah, I think it's a matter of confidence. And if you also look at it, the price in the SIP book is coming from the disposable income of the salaried class. So I think there's a significant shift in not just away from bank deposits. I think there's a shift from consumption into savings. So I think that's the thought process. Our per capita income has gone up from 2,300 to 2,700 levels. So that increased income, whereas the rich are getting richer, means that the K-shaped recovery and the premium segment continues. So there are automobiles today with almost 90 weeks of waiting period. So the premium segment continues to do well. So it looks like the K-shaped recovery is stretching more. But I think this festive season, I know the initial numbers are not indicating great, but let's just wait for the Diwali and the Christmas to get completed. I would like to see that the monsoon was good, so rural pickup should have been there better. But I think it's just a matter of delay. I remain positive on the consumption space because ultimately, right, the aspirations will come down below to the closer to the bottom of the pyramid. Recent corrections in that, because the festive season hasn't turned out as expected, means that I would look at still as a buying opportunity. I think in the next year, consumption will flatten out from a K-shaped to a U-shaped recovery over the period of the year, starting with next summer's thing. So I think that it's a good time to keep your consumption holdings and add to it on dips.
Naresh, though, are the charts indicating that, there have been a few odd inline to positive surprises from within the FMCG pack, though, although at large, most experts seem to be believing that it's a clear avoid right now as a sector. But what are the charts reading for a Dabur, Marico, Unilever, ITC?
So we saw a huge run in FMCG post-elections, which is where it became a defensive play, as well as there was good guidance from a few companies, but it has all faltered. So in this case, there are, say, selective chances which would come if we see another 5-8% correction, purely because the prices have corrected a lot. So for example, Dabur used to be 500, 530 before this rally went to 670 and is now coming back to that band. So closer to 500, 530, that's a buy. Hindustan Unilever, the stock went all the way to 3,000 odd levels, has corrected to 2,500. The base for the last 2 years is around 2,300, 2,400. So any correction of 5 to 8%, it again becomes a defensive buy and expect a slow and steady bounce over the next 6 to 12 months.
Right, okay, that's the take coming in on FMCG. Just marking some of the buzzers in today's trading session. Adani Enterprise is holding up a good 5% right now. Tata Consumer, Maruti also continues to hold out, and Hero MotoCorp is looking quite, smartly positioned indeed. Sunil, what's the analysis and the verdict now for the auto pack?
Well, I think the auto pack, I still remain a bull on the auto pack. Like I said, because this K-shaped to U-shaped auto with the two-wheeler segment, entry-level cars, I do expect next year to be good for them. I know that the auto index return has been much better than the large cap index return, which means it's run a bit of a rally. But I would remain bullish on that segment because now it will be more widespread and broad. And I would expect that not only will this Diwali show some pick, there's been lots of stock at the stocking points, and I think post Diwali you'll see that's been picked up. Again, March becomes again as a buying point because of the indexation and the taxation benefits. So I think that I remain a bull on the auto space, but remember that auto is not just one space, right? You have to split it up into the premium car segment and to the smaller end, which is two-wheelers. You have to look at the auto component segment, which is an export-oriented, and there the IMF saying the world is on a recovery mode augurs well for that. Then you have the agri-related tractor segment, which again with good monsoon and a good rabi crop should see some pickup. Then you have the commercial vehicles and CV cycle, and with the capex cycle picking up, I think the CV segment should do well. So if you disaggregate auto, I find there are a lot of spots there where you can buy. There are different time points, different price points to buy, but overall, I remain a buyer, bullish on the auto space. Some of them may have run up. You could, take some profits, but by and large, I would look at the auto pack as a consistent hold in your portfolio.
But since we're speaking about consumption, let's put the spotlight on Maruti Suzuki as well and hear out what the chairman, Mr. R.C. Bhargava, had to tell us.
I don't think the 14% kind of growth which we've had in the festival season can be maintained after the festival season. This happens every year. It's not an unusual event because festival season sales are much, much higher than what they are in other times of the year. And I certainly expect that after this Diwali things is over, Diwali festivities are over, sales will come down to their normal levels. This has certainly helped in clearing inventories and bringing things on a more even keel. But we don't expect this kind of sale levels to continue. I think we'll be in line with the rest of industry. We won't be better. Our first hybrid car, which is actually an SUV, a mid SUV, will be on show in a European motor show on the 4th of November. It will be unveiled there. The same car will be shown at the Auto Show in January. We will start the production of this SUV in April, export the first lots to Europe, and start selling in the domestic market from June. That's the current plan.
Welcome back. Well, the market continues to be around 24,350. Not a major move there as far as the market is concerned. But individually, of course, there are big buzzes in the trading session, and we have been talking about a few of them, which have actually seen a bit of an up move. Separately, on the losing side, it's Honeywell, MCX, Dixon Tech, which are down in the trading session, and some of these names continue to reel under pressure. L&T will report its numbers today, so let me take it across to Ria to get more understanding as to what the expectations are, because it is expected to be a bit of a modest quarter this time. We have a growth of around 14% penciled in. Ria, but what about the other internals?
So L&T is all set to report its Q2 FY25 numbers today. So let's take a look at what the street is penciling in for these numbers. Firstly, the revenue is expected to go up around 13% on a year-on-year basis. The EBITDA is expected to go up around 9%, and the net profit is expected to go up around 3%. If you look at the margins though, the EBITDA margins are expected to come in at 10.66% versus 11% this time last year. And this continued weakness in the EBITDA margins is largely due to the commodity prices or cost overruns. Let's also take a look at some some of the other factors that we're keeping an eye out for on this front. Firstly, the order inflows are expected to be a bit muted in this quarter, and this is because of a large base effect and also because the domestic ordering momentum has been muted because of the delayed decision making on account of the impending state elections in this quarter. There is also some pickup in execution that is expected on the domestic front after the labour shortages that were faced in the last quarter. Let's also take a look at some of the key monitorables for L&T. Firstly, we are looking out for the management commentary on the hydrocarbon order prospects, domestic labour shortages and the performance of the Hyderabad metro project. The domestic order pipeline is also something that we're keeping an eye out on, along with the recovery in the core infra segment margins. Another thing that we are keeping an eye out on is the execution ramp up in the Saudi projects and the trend in the GCC pipeline, and also the impact of the continued tensions in the Middle East and the crude price movements. Remember last quarter they had said that the full year order inflow guidance still stands at 10% for the full year FY25, and the full year order prospects are at rupees 9 trillion. So we are expecting some revised guidance on this front as well. So these are the factors that we're keeping an eye out for on L&T.
Okay, that's that on L&T. But as we step into the new submonth, let's also revisit the year gone by and the stocks that made waves on the upside and the downside. While Trend saw the biggest target upgrade, Fusion Finance saw the maximum target downgrades. Gaurav is here with that entire list.
Well, yes, we are entering into summer 2081, and when we talk about summer 2080, we saw a big upgrades as well as downgrades. We saw derating happening in the stocks, we saw re-rating happening in the stock, and we have collated a list of few stocks where we have seen a massive re-rating. And first, when we talk about this list, first list comes, this is Trent. When we talk about the stock performance, also the stock has gone up almost by 250%, and even from the brokerages, we have seen the same bullish trend. When we talk about the target price, earlier the target price was somewhere set at 1937 rupees. We have now seen around 250% upside on this target price. Now consultants say that the target can actually go around 6,723 rupees. Other than that, when we talk about some consumption players, we saw Kalyan Jewellers also actually outperforming when it comes to re-rating. There also we saw a massive target upgrade of around 200%. Other than that, Zomato is another candidate where we saw a massive upgrade and re-rating happening, not just because of the re-rating, but also because of based on the fundamentals as what we have seen in the company. Other than that, when we talk about some of the other companies where re-rating has also happened, and we also see some kind of further upside for these stocks. So where there comes the first name is Gravita India. The consensus have already actually re-rated the stock almost by 166%. But even after considering that, the current target price suggests that we may also further see around 50% of the upside. Other than that, when we talk about Sobha and Prestige Estate, there also we have seen a massive upgrade coming up, and at the same time we also see some kind of further upside which is left for the stocks. When we talk about some of the losers in this year, we also saw some of the stocks where we saw de-rating happening, and the first comes is Fusion Finance. So as we know that MFI is actually in stress, and that is the reason why we saw some kind of stress coming up in financials, and Fusion Finance was one of the stock where we saw a massive de-rating happening. The stock de-rating has happened almost by 60%, and at the same time when we talk about the stock performance also, that has gone down almost by 67%. Other than that, when we talk about some of the players like Paytm, we have IIFL Finance where we saw some kind of de-rating happening, not just because of the rating, and at the same time we saw some fundamentally also the changes in the companies. Rather than that, when we talk about some other companies, we also have some famous names like Bandhan Bank and SBI Card where we saw de-rating happening, but at the same time, given the consensus target price, we still see some kind of further upside. So for Bandhan Bank, we see some further upside of around 16%, while for SBI Cards, we see some further upside of around 6%. So overall, when we talk about summer 2080, it was a massive year for some of the stocks whereas it was a little sluggish year for some of the other stocks. Definitely watching out on what happens in summer 2081 and how the stock de-rating or re-rating happens. But for now, it seems that some stocks are still there where we may see some further upside as per brokerages.
Thanks so much for that. We will watch out for the re-rating and the de-rating. But Sudeep, if I had to ask you what the sector, which is one of that sector which is poised for a bit of a re-rating this year and de-rating this year, what would be your bets?
Which hasn't really seen too much of excitement is the BFSI. Yes, we have seen sharp correction in some of the segments of BFSI in the recent past, particularly the microfinance lenders. But overall, we believe that the insurance sector deserves probably a re-rating. We also believe that some of the gold loan companies deserve a re-rating. Some of the banks, I think they're performing exceedingly well and they deserve some kind of valuation upgrade. So, these are one single pocket where the largest potential exists is what we believe in Samvat 2081. Apart from that, there are multiple pockets. Let's say in the construction infrastructure space, we believe that Larsen deserves a re-rating. I just saw the chart being put out, Gravita, the recycling industry. I think there the environmental consciousness world over is increasing. And again, yes, there has been a couple of re-rating, but further re-rating is possible considering they have entered the European market and the opportunities in Europe are humongous.
Right, okay, that's that in Gravita. But Sudeep, other than that, where is it that you've been shopping in the current decline or not yet?
From the sidelines mostly. Little bit of nibbling in some of the stocks I mentioned, insurance segment, recycling, as well as construction infrastructure I have been. But beyond that, I've been watching. I think the way we are looking at the market, we believe the volatility will continue for the next few weeks. There are too many events lined up. There is a US election. There is Maharashtra state election, which is definitely important in overall context of the markets. And of course, what's happening in the Gulf, what's happening in between Russia, Ukraine, and the flip-flop in China about incentives or no incentives, what kind of incentives, what kind of stimulus to be given. So I think there is a bit of a volatility, there is a bit of a uncertainty all around us. So I don't see too much happening in the next few weeks. So I will rather wait and watch instead of start buying in a big way now.
Not buying in a big way just yet, but just nibbling in. But let's talk about the November seasonality as well. Traditionally, what is it that we've seen and observed in the month of November? Samit is here with all the analytics. Samit?
Well, if you look at the last 10 years of the month of November for the main indices, the Nifty has closed in green 6 times, while the remaining 4 times it has ended in the red. While the average returns over the last 10 years have been around 2% when it comes to the Nifty 50 index, which is the benchmark index. When it comes to the Nifty mid-cap index, in fact, the broader market, that is the mid-cap and the small-cap, have performed better in the month of November because they have both closed in the green 8 times out of the last 10 Novembers, and the average return when it comes to the Nifty mid-cap and the small-cap indices have been around 3%. Now, if you look at the sectoral indices, is the Nifty Bank, Nifty Media and the Nifty PSU Bank Index, which have performed the best because they have closed in green nearly 8 times out of the last 10 times, while the average returns have been around 2 to 6% for these 3 indices. When it comes to Nifty FMCG, Nifty Financials, Nifty IT, Nifty Private Bank and Nifty Real Estate Index, these indices have closed in green 7 out of the last 10 times, while the average returns have been anywhere close to 2 to 4%. And when it comes to Nifty Auto, Nifty Metal, Nifty Energy and the Nifty MNC Index, they have closed in green around 5 times out of the last 10 times, while the average returns have been around 2 to 3%. And the least in the in the sectoral indices is the Nifty Pharma and the Nifty CPSE Index, which have closed in green just 4 out of the last 10 times, and the average returns for the Nifty Pharma have been negative 0.6%, while the Nifty CPSA index on an average basis has been flat in the month of November. Now, this is the most interesting part where we have considered the stocks that have closed in green most times in the month of November. Nifty now in the stock list, it's Tata Com and Persistent, which have closed in green nearly 9 out of the last 10 times, and the average returns have been around 6 to 7%. Then there is Birla Soft, Apollo Hospitals, SBI, IndusInd Bank and Biocon, which have closed in green 8 out of the last 10 times, while the average returns have been anywhere close to 5 to 7%. Now, a couple of stocks that we also need to keep an eye out for from the negative side of the market, and that's UPL, Cipla and SBI Card. Now, SBI Card has never closed in green in the month of November, while UPL and Cipla have closed in green around 2 to 3 odd times. Now, the average decline for SBI Card in the month of November has been around 3 odd%, while that for Cipla and UPL have been close to 2 to 3 odd%.
Okay, point taken. So that's the November seasonality for you, which is expected to perhaps creep in, and let's see which way it goes. AB Capital reported its numbers, and that stock is reacting positively at the moment. So let's pull up the intraday chart of that one. The profitability has come in at close to 1,000 crores, so that's one stock to watch out for. And the other one that I'm looking at is Tata Chemicals. Kunal, on the charts, AB Capital, Tata Chemical, any view?
So both of them are attractive. AB Capital is something which I've been recommending over the last few months. The stock has done reasonably well from 160 to at a point where the stock was almost at 220, 240. Now it's come back to that 215 to 220 mark, which means it should be good for a breakout back again about the 220 level. So maybe we can wait out for a day, or a couple of days before the stock breaks past about the 220 levels. That could be a strong breakout move for AP Capital yet again. For Tata Chemical, I think this could be a very interesting move because the stock for the last 2 years, 3 years was trading into a range 1000 approximately as a support for the stock and 1100 to 1200 as a major resistance zone for Tata Chemicals. There have been, I think, very recent attempts for the stock to try and scale past about the 1200 mark, but it's met with a lot of supply as well as resistance. But the way the indicators have started to slope up higher for Tata Chemicals on the daily charts, the weekly charts, gives a sense that maybe the stock is getting ready for a breakout on the upside. So either as a breakout, we can look out for 1200 as a breakout play for Tata Chemicals, or in the anticipation, I think even at current levels of 1130, it could be a very good buy.
Okay, that's the take on some of those interesting names there. Concord, look out for that one. We were chatting with the management as well earlier in the day. 4% higher after reacting to its numbers. Marico as well looking up by about 4%. There's Escorts, which is also higher by 3.6% as we speak right now. Reliance relatively tempered. About a 0.4% kind of uptick is what you've seen on this particular stock. Other than that, of course, it's pretty quiet for a Bharti, for a TCS, flat for Tata Motors as well. And some of the metal names are the ones which are actually seeing a little bit of weakness. So Tata Steel, Hindalco, those are names which are actually laggards in right now's trading session. But let's also hear it out from Ravi Dharamshi. Investors clearly still seem to be wary going into this ongoing correction in the market. But is this a routine cleanup or cause for worry? Hear out what Ravi's opinion was.
Because of just the sheer magnitude of the returns, we should temper our expectation in terms of what kind of returns we should expect. And we don't talk in terms of 12 months, we talk in terms of 3 to 5 years. Can we still get double-digit returns from the market? I would say definitely possible. If you are smart enough and can generate alpha, you can do slightly better than that as well. But definitely should not have expectations more than that. Some volatility is to be expected, and we should be trying to take advantage of that volatility rather than getting scared of it. Shallow in terms of correction, I think we have already corrected some 8-10% from the peak. Can it correct another 5, 7, 10%? I cannot rule it out just because we have the kind of returns we have had, and the valuations are a little on the expensive side. So with the slowdown and with the kind of valuations we are seeing, it's absolutely par for the course. So from the peak to correct around 15% kinds is, I would say. Markets last 3 years have done well, and the numbers are there. The kind of flows mutual funds are getting, all that is getting baked in. But we believe this is not the end of the story. This feels like this is going to have a long runway. We are still at about unique around 9-10 crore kind of demat accounts. I think that number has to swell to 20-25 crore by the turn of this decade, and that will mean the sustained growth. So there will be a lot more beneficiaries coming out of this sector, capital markets place. We like wealth managers, but there are other plays like exchanges, brokers, discount brokers, market infra companies. Those are all reporting good numbers. That should do well. We do like insurance as well. Insurance has had a bad 5 year. Of course, last 6 months have been good, especially on the general insurance side, because the competitive intensity has finally abated.
Okay, so that's a view coming in from Ravi Dharamshi. Pull up the stock of DBER because the numbers are just out. The revenue from operations has come in at 3,028 crores versus 3,200 crore last year, but not very surprising because the street was penciling in a decline. So that is exactly how it's panned out. So on the top line, it's looking in line with expectation. Profitability was expected around 450 crore thereabouts. The actual profitability, however, has come in a little lower at 417 crores. So on the profitability bit, there seems to be a bit of a miss. Just trying to watch out for the numbers coming in as far as the EBITDA margin profile is concerned as well. The margin has declined by almost 200 basis points. The margin profile has come in closer to 18%, which is a tad bit better than what we were working with. So that's why the stock is a bit volatile. On the top line, it is in line with expectations. The margins also in line to a little bit better. Profitability is a smidge lower, but that could also be the case. There is some adjustment, etc. or the taxes are on the higher side, and that's the reason we are seeing a bit of a miss on the bottom line, but overall a decent set coming in from DBER. In fact, Sudeep, what's your take on this entire staples basket? We saw the numbers coming in from Marico. That stock was higher 8% at the start of the trading session. DBER, the number is just out. It's a bit sideways. Is it the right time to buy when there is, when there is still a bit of a concern because you're getting it at a good price, or you would want it to play out and buy it after a couple of quarters?
This is probably the right time to start nibbling into some of these stocks. DBER had already given a warning about the competitive intensity a few weeks back. So a little bit of subdued numbers were expected, and the numbers are by and large in line with the expectations. So I won't read too much into these numbers. But our belief is that DBER will start recovering from the Q3 onwards. We have a festive season now, and then followed by Q4, which is normally strong on consumption of DBER products. Because they have a large Chyawanprash portfolio, which gets more and more consumed during the winter months. So I believe that while the intensity in the soft drinks and the beverage segment is too much, and that's where DBER will probably take some hits, the other segments will more than make up for the shortfall in the beverage segment. Thus, DBER definitely at current level looks good from a long-term investor's point of view. Some of the other FMCG stocks also, like HUL, now it had gone up to 3,000. It has come to around 2,500 levels now. A little bit of correction here and there from a long-term investor's point of view, it will be a good buy. So FMCG, definitely it's worth dibbling into.
Sudeep, good to have you on the show. We'll let you go on that note. Thanks as always for taking the time out. Let's just revisit what the market is doing currently, because it's still that 0.5% downtick. Unfortunately, right now the dip hasn't gotten bought into by any standards. MCX, Dixon, Volta, Cipla, Idea, they continue to be rank underperformers. Infi is down 2%, so is Trent, DRL, M&M, 8cell Technologies, Kotak, and a whole host of other banks as well, weighing heavy on the markets as we speak right now. But let's welcome on board Ramesh Gopalan as well, the MD and Group CEO. And we also have the Group CFO of Sagility India talking about their upcoming IPO. And Ramesh, if I could just start off with you, your company says that it's the first to list in this particular segment that you belong in. Tell us a little bit more about not just the company, but the business model that you've adopted.
Sure. Sagility is a tech-enabled business solutions and services provider to the US healthcare industry. So the work that we do is for two sets of clients. One is payers. Payers are health insurance companies in the US, and providers are hospitals, physician groups, lab companies, and so on. So these are the two sets of clients that we work for. And so the work that we do for them is supporting them in all of their operational activities. So for a payer, it would mean helping them with enrolling new members, processing claims for them, helping them with premiums, helping them with some of their clinical programs, and so on. So that's the work that we do for our clients.
Point taken, but tell us about the IPO, because I understand it's total OFS. Why is Sagility BV looking at selling stake if you're so confident about the business model and outlook?
So Sagility was formed in at the beginning of 2022. It was created as a result of a carve-out of the healthcare business from Hinduja Global Solutions. And so Barings Private Equity Asia, which is now EQT, is the 100% owner of this company through Sagility BV, which is the parent company of Sagility India. So this IPO is an offer for sale of 15% of their shareholding in Sagility India. And so this is not a primary issue, but it's an offer for sale.
Right. So Ramesh, the dilution is only about 15%, which means we are going to be seeing no further dilution in the company according to the SEBI norms. Have you spoken to any of your investors for the remaining stake?
So we have a time frame by which we can do that. So at this point in time, we've been speaking with investors, obviously, to help them understand the business. And so right now the focus is on getting this 15% offer for sale done. and then over a period of time to comply with the norms, we will increase it to 25%.
Okay, help me correct if I'm wrong, Ramesh, but almost all of your revenue comes from the United States and the company caters to the pharma sector there. In context of that, how do you think US elections are likely to impact your business? Because there's a lot of chat about US biosecure at its sector. How will that impact your business, if at all?
Listen, we've been in business for 24 years. We've seen multiple presidents in the US and different parties in power. And so it doesn't really impact the core work that we do. Obviously, healthcare is a critical subject in the US. Having said that, the work that we do is primarily to support our payer and provider clients in running their operations. And we don't see a big impact to our business, irrespective of the outcome of the elections.
Right. So what's going to be the major growth trigger then for the company, and any growth capital which you currently need?
Like I said, the company generates cash on an ongoing basis. And so we don't need primary capital to grow. We generate free cash that we can deploy for growth. And in terms of growth triggers, we still have a huge opportunity in the US. US is a $4.7 trillion healthcare market. And if you look at our client profile, a large part of our client base is some of the top payers in the US. We are aggressively growing our footprint within those clients, as well as trying to add new clients to the portfolio. And so given a broad service portfolio and a deep domain expertise in the US healthcare industry, we are very confident of continuing to grow our revenue.
Confident about growing revenue. Thanks, gentlemen, for making time and speaking with us, and good luck for the IPO. But for the markets right now, it's ITC which is holding one end of the market. There is a jump of around 1% there. L&T ahead of its earnings is close to the highest point, I believe. That stock is doing quite well. While on the flip side, of course, you do have Infosys, which is down 2%, ICICI Bank, which is retraced a bit. Let me now get our chartists on board and talk about the BTSC trade. Naresh, you go first.
First is a buy on UPL. The stock has bounced back from the support zone. Stop loss at 540, target price of 570. Second is a buy on Ramco Cement, which is close to a breakout now. Stop loss at 880, target price of 900.
Kunal, what about your BTST ideas?
The buy on Radico, that's a chart which is looking attractive at current levels of a breakout, and after almost 4-5 days of consolidation, would look out for targets in the range of 2450, stop loss at 2280. And Concor is the other stock which I suggested in the morning. Looks very attractive. The stock is up 3.5 to 4%. I think at 839, 840 where it's trading right now, would look out for targets in the higher range. 875 as a revised target, stop loss trail to 805.
Pull up the intraday chart of Bank of Maharashtra, please, and let's take a look at as to what that's doing, because on my charts it's suggesting that there is a sudden spike that has come on Bank of Maharashtra. Yes, that's true. Kunal, you have been watching out for some of these PSU banks. Bank of Baroda is something that you liked. PNB is also something which you were optimistic about. But what about Bank of Maharashtra?
Yeah, it's an interesting chart. So, on the longer term basis, the stock has a major resistance at the 775 mark. But then the recent correction which has happened for many of these PSU banking names indicates that we are now getting into the zone where the PSU banking stocks would start to get back into a line of covering up the huge underperformance. So we've seen few large cap PSU banking stocks looking attractive. Now I think it could be time where many of the mid cap and the non-FNO stocks on the PSU basket, they could start to show signs of momentum. So we're seeing the first round of volume push coming into these names. Slowly, when these stocks clear past about their immediate resistances or hurdles, we'll start to see more of a trending nature into these stocks. So bullish on the space. Bank of Maharashtra, I think the stock is just 5-6 points away from its breakout of its previous highs around the 200 DMA 60-61 mark. So I think that could be an immediate target for the stock if someone is looking at a trade.
Okay, that's the take coming in on what the PSBs are up to. In the meantime, let's also take a look at, other than PSBs, what else is it that you're seeing in the market right now? While, of course, the breadth is about 100 account to the declines and about 84 or to the advances, so not really a big margin there. But that said, it's the small caps which have actually led today with a 1% gain coming in for the small cap index. We've been talking about as to how you had Manappuram, Marico. These were some of the gainers in a trade today. And also bring out, what else has actually held out and what is it that you've actually seen some decent amount of gains on. So AB Capital, a 5% uptick coming in there. Marico, like we've been flagging off, 3.6% higher for that stock as well. Tata Chemicals closes in with a 3.6% gain. There was Concor earnings reactions there, 3.5% of an uptick coming in on that stock. Chambal Fertilizers did pretty okay. In fact, all these stocks have actually seen a long build-up for themselves. So yeah, Chambal Fertilizers as well, going home with a good 3% of a gain. There was Escorts, Dalmia Bharat, which has done pretty well. OFSS, that's looked pretty okay. Bharat Forge has done a move of about 2.5% in the green. PVR Inox shot up about 2.25% as well. There was Dabur. We were just reacting to its numbers and highlighting that for you. 2% higher for Dabur as well. I think a chunk of the damage was already done with when the quarterly updates came out for Dabur. Ramco Cement as well has not been bad. There's been Coromandel International as well, which has also seen some long build-up and a gain of about almost 2% on that stock. PI Industries, UPL, these have been some of the good performers. But short build-up for MCX, that cracked 6.5%. There was Dixon, which is lower by about almost 5% or so in trade. Voltas fell hard by about 4.5%. There was Cipla as well, which saw a 4% downtick coming in. Idea fell 3.5%. Samvardhana Motherson was down about 3%. Oberoi Realty, HPCL, Godrej Properties, IEX, REC and Infosys. These have been some of the rank underperformers. So choppy market, but within a narrow band, one would definitely have to say. We've managed to cling on to that 24,400 print, however. But let's see how tomorrow's trade pans out. The last one, of course, for this year. And then, of course, Friday, we'll have the Mahura trading on Diwali day in the evening. We'll catch you again then tomorrow morning at 8 a.m. with all the market action.
If you like this video, then like, share and subscribe to ET Now.